You probably check your investment fees and think you're paying almost nothing, maybe 0.5% or 1% annually. But here's the terrifying truth. There's a hidden fee that most investors never notice, and it's quietly stealing $25,000 from your retirement without you ever seeing it on a statement. Now, I'm not talking about the expense ratios that everyone knows about. Those are clearly disclosed and relatively easy to understand. What I'm talking about is a fee that's completely legal, rarely discussed, and costs the average investor more than all their other fees combined. This hidden fee is so well disguised that even sophisticated investors miss it. I discovered it after analyzing thousands of investment statements and realizing that investors were losing massive amounts of money to something that doesn't even appear as a line item on their reports. In this video, I'm going to reveal exactly what this hidden fee is, show you how to calculate how much it's costing you personally, and give you the simple strategies to eliminate it and keep that $25,000 for yourself. Body point 1. The bid-ask spread. The invisible wealth killer. Here's the hidden fee that's stealing your money. The bid-ask spread. And most investors have never even heard of it. Every time you buy or sell a stock, ETF, or mutual fund, there are actually two prices. The bid price, what buyers are willing to pay, and the ask price, what sellers are willing to accept. The difference between these two prices is the bid-ask spread, and it comes directly out of your returns. Let me show you how this works with a real example. Let's say you want to buy shares of Apple stock. Bid price, $150. What buyers will pay? Ask price, $150.10. What sellers want? Spread, $0.10 per share. When you buy 100 shares, you pay $15,010, but your shares are immediately worth only $15,000. You've lost $10 before the stock even moves. When you sell, the same thing happens in reverse. For large, liquid stocks like Apple, the spread might be small. But for smaller stocks, international funds, or specialty ETFs, the spread can be 0.5%, 1%, or even 2% of your investment. Here's the shocking math. If you invest $500 per month and pay an average 0.5% bid-ask spread on each transaction, you're losing $30 per year just to the spread. Over 30 years, that's $25,000 in lost wealth. And that's before considering the compound growth you lose on that money. Body point 2. How market makers profit from your ignorance. Now let me explain who's collecting this hidden fee and why they never want you to know about it. Market makers are the firms that provide liquidity to the stock market. They're the ones creating the bid-ask spread, and they profit every time you trade. Companies like Citadel Securities and Virtu Financial make billions of dollars annually from bid-ask spreads. Here's how they do it. They buy stocks at the bid price and sell them at the ask price, keeping the difference as profit. They do this millions of times per day, making tiny profits on each transaction that add up to massive revenues. The more you trade, the more they profit. This is why free trading platforms like Robinhood can offer commission-free trades. They're selling your order flow to market makers who profit from the bid-ask spread. A study by the SEC found that retail investors pay an average of $4.50 per $1,000 traded in bid-ask spreads. That might not sound like much, but it adds up quickly. $500 monthly investment, $27 per year in spreads, $1,000 monthly investment, $54 per year in spreads, $2,000 monthly investment, $108 per year in spreads. Over 30 years with compound growth, these small fees become massive wealth transfers from your pocket to market makers. Body point 3. The frequency trap that multiplies the damage. Here's where the hidden fee becomes truly devastating. The more frequently you trade, the more you pay in bid-ask spreads. Many investors think they're being smart by rebalancing their portfolio monthly, dollar cost averaging weekly instead of monthly, trading in and out of positions based on market news, using multiple small purchases instead of larger ones. But each of these strategies multiplies your bid-ask spread costs. Let me show you the math. Scenario 1. Monthly investing. 12 transactions per year. $500 per transaction, 0.5% average spread. Annual spread cost, $30. Scenario 2, weekly investing, 52 transactions per year, $115 per transaction, 0.8% average spread, higher for smaller transactions. Annual spread cost, $208. The weekly investor pays almost 7 times more in bid-ask spreads for the exact same investment amount. Over 30 years, this difference compounds to over $150,000 in lost wealth. This is why the financial industry promotes frequent trading and rebalancing. It generates more bid-ask spread revenue for market makers and more commission revenue for brokers. Body point 4. The simple strategies to eliminate this hidden fee. Now let me show you the specific strategies to minimize or eliminate bid-ask spread costs. Strategy 1. Invest less frequently with larger amounts. Instead of investing $125 per week, invest $500 per month. Instead of $500 per month, invest $1,500 per quarter. Larger transactions have lower percentage spreads and reduce your total trading frequency. Strategy 2. Use limit orders instead of market orders. When you place a market order, you automatically pay the ask price when buying or accept the bid price when selling. With limit orders, you can specify the exact price you're willing to pay, potentially saving the entire spread. Strategy 3. Trade during market hours. Bid-ask spreads are typically widest during pre-market and after-hours trading. Stick to regular market hours, 9:30 a.m. to 4 p.m. EST, when spreads are tightest. Strategy 4. Focus on high liquidity investments. Large-cap stocks and popular ETFs have much tighter spreads than small-cap stocks or niche funds. The S&P 500 ETF SPY typically has spreads of just 0.01%, while small international funds might have spreads of 1% or more. Strategy 5. Avoid frequent rebalancing. Instead of rebalancing monthly or quarterly, rebalance annually or only when your allocation drifts more than 5% from your target. This dramatically reduces your trading frequency and spread costs. Body point 5. The real cost of free trading. Let me expose the biggest lie in modern investing. That trading is free. Platforms like Robinhood, Webull, and others advertise commission-free trading, but they're actually making money by selling your order flow to market makers who widen the bid-ask spread. A study by Barron's found that Robinhood users pay an average of $2.59 more per $1,000 traded compared to users of traditional brokers like Fidelity or Vanguard. That's because traditional brokers negotiate better execution prices for their clients. Here's the math on how free trading actually costs you money. Robinhood user, $0 commission. Per trade, $2.59 per $1,000 in hidden spread costs. Annual cost on $6,000 invested, $15.54. Fidelity user, $0 commission per trade. They also offer free trading now. $0.5 per $1,000 in spread costs. Annual cost on $6,000 invested, $3. The free platform costs you $12.54 more per year, and over 30 years with compound growth, this difference becomes thousands of dollars in lost wealth. The lesson? There's no such thing as free trading. Someone is always paying, and if you can't figure out who, it's probably you. Look, I know bid-ask spreads aren't the sexiest topic in investing, but they're one of the most important. This hidden fee is quietly stealing thousands of dollars from millions of investors who don't even know it exists. The financial industry doesn't want you to understand bid-ask spreads because they profit from your ignorance. Every time you trade, they make money. The more frequently you trade, the more they make. But now you know the truth. You can either continue paying this hidden tax on every transaction, or you can implement the strategies I've shared and keep that money for yourself. Remember, investing isn't just about picking the right stocks or funds. It's about minimizing all the costs that eat away at your returns. Bid-ask spreads are often the largest cost that investors never see. If you want to calculate exactly how much bid-ask spreads are costing you, I've created a free spread calculator that analyzes your trading frequency and investment choices. You can grab it in the description below. The choice is yours. Keep feeding the market makers, or keep your money and let compound interest work for you instead of against you. Thanks for watching, and I'll see you in the next video where we'll dive deeper into choosing the most liquid, low-spread investments for your portfolio.